Students, welcome back. Like I said previously, we're going to speak about the income statement. We're first going to read in our notes, the income statement of a production business is similar to that of a trade concern. The only difference is how cost of sales is calculated. Now, why do you draw up an income statement? Is to calculate if the business made a net profit or loss for a financial year, normally for a financial period, or you can even draw it up for a month or two. When the income statement is drawn up, only office income and office expenses are used. The only factor items used is finished goods and MOH under or over applied. Now, when you draw up the income statement, the exact same information you use for the trading account and the profit or loss account is used. Now, when you do the income statement, they don't give you the cost of sales, so you need to calculate it. And like I showed you before, the same information you use when you drew up the cost of sales, when you did the production cost statement, you use that same information. So we're going to go out to the layout of the income statement, which I gave you. So the first thing you use is sale of finished goods or turnover less cost of sales. So how do you calculate cost of sales? You take your finished good at the start of the financial year, you add it to the cost of production of finished goods. Now this amount, if you've done the production cost statement, that's the final amount. If they only ask you to do the income statement, then that amount will be in the activity or the question. Then it's under applied. If you had under applied, you say add. If it's over applied, you say less, but you can't have under and over applied. So you will add these three amounts and you add it together and you call it finished goods available for sale. And then you say less finished goods at the end of the financial year. That's this information here. Then you take the 151 minus the 40,000 and that will give you 111,000. So you take your sales, which is what you sell the goods for to your clients, minus the cost of sales, and that will give you gross profit. Then you say add other income. And your other income is like your rent received, your interest received, and your commission received. You add it together and that will give you 18,000. Now, if you don't have other income, then you will put null over here. And that will be 589. But I gave you some other income items. So you will say 589 plus 18,000, and that's 607. Then you say less expenses. The expenses you pay to run the office will be like your selling and admin, your advertising, your salary of the sales and secretary, office rent, office electricity, and office telephone. So you add all these expenses up and it will give you 400,000. So you have a gross income of 607 and expenses of 400, and there's your net profit before tax. If they give you the tax, then you put your tax there and that will be net profit after tax. So that's the income statement, basically using your information you use to do your trading account and your profit and or loss account. The same information you're going to use to do your income statement. Now, they will never give you cost of sales. The cost of sales amount you will have to calculate using this information over here. So I'm going to forward this video and then I'm going to forward some activities for you to do. Thank you.